If you're somebody who is young and thinking about going to college, if you are an individual who's gone through some struggles and you're trying to get your life on track and build more prosperity, I am absolutely convinced that all of the videos in this playlist that you see on my YouTube channel will help you position yourself to get on the pathway to prosperity. I am not saying that college isn't the right route for some people, but there are so many people in our society that are struggling in student loan debt. And it's my absolute belief that an individual who learns a little bit about business can start thinking about how can I make the best investments that will lead me on to success. My name is Michael Santos. I was in prison for 26 years, but because I learned a little bit about business, it put me onto a position or onto a track where I could start building prosperity. And you can see a lot of that through all of these videos. In this playlist, this is number 7 in this very simple course on understanding small business. We have been building a case study for Michael's Hot Dogs. It's really quite a simple case study, but through it we learned a little bit about forming a corporation, we learned about equity, we learned about debt, we learned how to divide a corporation into multiple shares, we learned how to record our assets and liabilities, building a financial statement that would help us to assess where our investment is. We saw how this business grew during its first year of doing only $800 in revenues and generating a loss of $15. We saw how it grew in year 1, 2, 3, 4, and 5 to by the time we were in year 5, it was actually making $2,311 and bringing a net profit for investors of $1,500. But in addition to this net profit, which is about $1 a share, we also have to consider the cash flow statement. An understanding of all of these different financial metrics are what is going to help you make better financial decisions, become a better investor, and as you start evaluating and assessing how your decisions are going to influence your future, I'm absolutely convinced you will advance your pathway to prosperity just as I did, and it all started with a firm understanding of small business. And for those of you who are following along in the earlier episodes of this course, you know that in year 1 we had a $10 loss, we had a depreciation expense of $60, cash that resulted in cash from operations of $50, and that pattern continued with year 2. You're increasing our cash flow a little bit, increasing our holdings. When year 3 we continued again to ultimately we generated $475 in cash in year 3. Year 4 we generated $1,617 in income. After depreciation, cash from operations was $857. And here's what's really important. By the time we reached year 5, which was the end of our statement, we not only had $1,500 in income, but we also had cash from operations of $1,922. So cumulatively, the cash flow from investing in fixed assets really brings value to the corporation. Remember, we started with $300 in fixed assets just for that first hot dog stand, but then we continued to add hot dog stands that were completely funded by the corporation. And over the course of those 5 years, we added a total of seven hot dog stands, all generated internally. During the first year, all of our cash really came from the $500 equity investment and the $250 in debt. But as we started to move through years 1, year 2, year 3, year 4, year 5, we started to really add more cash. In year 5 alone, we added $2,165. But over the course of 5 years, we really built our cash to more than $4,000. And that is what led this business to become far more successful. We didn't have that during the first year, but by the time we worked through 1, 2, 3, 4, and 5, the business grew in value over time. And at the end of year 5, Michael's Hot Dogs had about $4,000 in shareholder equity, that's almost 3 times what it was when the business first started. Now, as a result of our excellent financial records, we can now see whether Michael's Hot Dog Stands was a good business or a bad business. We weren't able to see that after year one because all we saw was a loss. We lost $10 gross, $15, we made $10 gross, but that after we paid our interest, it resulted in us losing a total of $15. But one way of assessing whether the business is a good business is to judge it by how much money it is earning as compared to how much equity we have in the business. Now remember, we initially valued the business at $1,500, but at the end of year 5, based on the balance sheet and its earnings of more than $1,500 per year in profit, we know that we have more than 3 times the equity of the first $500 in cash that an investor put in. In fact, the business is now generating a 100% return on the cash equity that went into the company, and it looks like it's going to continue generating more and more cash every single year. That's what's important for us as investors to begin thinking about, hey, is this a good business or not? When we compare the performance of Michael's Hot Dogs to other business, we really see that it's doing quite well. You see, as the business grew, it generated $2,100 in brand new capital. We used that capital to invest in those additional hot dog stands. 7 hot dog stands at $300 each is $2,100 that the business completely paid for, and all of that, if we don't take depreciation expenses into account, all of that really benefits investors, those who have equity in the business. And so these are the types of concepts that we need to be thinking when we are assessing a business. We now have a business that's generating $1,500 a year, which is basically $1 a share. We know that profitability went through the roof. When it started, it was 1.3% profit margins. By the end of year 5, we were doing 28% profit margins. And we can assess this all from the perspective of saying this business is doing far better than our capital would have done if we just left it sitting in the bank. The business has been profitable. It's serviced the debt holder very, very well. You may remember that we borrowed $250 at 10% interest, and we paid in that interest every single year. But because the business is doing so well right now, he is in a very secure position. He's been earning $25 a year, so after year 5, he's already taken $125 in interest income, and the company still owes him $250. But we have much more than that in cash, so the debt holder is really doing well. He's totally secure, very happy with his 10% yield on the interest that he is earning, and he's doing well unless we're going to compare the debt holder to the equity investor. I mean, the equity investor only put up $500 for 500 shares, but by year 5, that equity investor has really gotten a great return on his money. In fact, he's earning 100% of what he put in every year. Why? Because we have $1,500 in profits. I own 1,000 shares, so I'm entitled to $1,000 of that, but he's entitled to $500, so 100% yield on his money. That is really something that is significant. We do know that the equity shareholder is compensated at a much higher rate than the debt shareholder, and there are some good reasons to differentiate equity holders from debt, right? Because a debt, somebody who holds debt, they're in a higher position. They are safer than somebody who holds equity. And I think it's important, it bears importance to try and understand that if you are a new investor. Because as an investor, you always have to assess, how well am I doing? What options do I have? And the more we understand debt and equity, the better position we are in to make a decision on where are we going to put our money. So let's recap this of what is the difference between the equity shareholder who purchased shares in the corporation versus the individual who lent the company money. Why does the equity shareholder get such a larger pie? He's making he's participating in this $1,500 in profit, but the debt holder is only getting the 10% interest payment that we initially promised him. Okay, he's making he's invested $250 and he's getting $25 a year. It's nothing to sneeze about, but this guy's getting $500 a year. So, I mean, if you just doubled it up, the debt holder, if he lent $500 and he was getting that same rate of return, he'd be making $50 a year versus $500 a year for the equity stakeholder. So there's a very good reason for that. The equity stakeholder is taking on a lot more risk than the debt holder. The debt holder, remember, let's listen what he did. He lent $250, but that $250 was guaranteed by all of the assets of the corporation. And remember what the corporation did. When it first started, it purchased a hot dog stand for $300. Let's say that the corporation went out of business completely. Well, the debt holder would have a right, he would have a lien against any assets that the corporation held. And the corporation, we know, had a fixed asset, a hot dog stand that was paid for $300. It had some value because it was brand new. Maybe the hot dog stand, you could sell it on the open market for $100, $150. Say it lost 50% of its value, you just sold it for $150. That would go to the debt holder. So the debt holder has some security. And it's important to realize that when you have security, you're really in a position where you're not going to lose all of your money. You always have some claim that can help you recoup your money. There's all types of debt, okay? There's debt like this individual made, which is a simple interest-only note to the business, but it could be structured in a number of ways. Like you may know about a mortgage. When somebody issues a mortgage, they have a right to the property. And the property, before the owner of the property gets anything, the debt holder gets the money back. If this business had gone out of business, instead of performing so well, the debt holder would have gotten all of his money back, or would have gotten whatever the corporation had in assets and they could liquidate. The debt holders get paid first, employees get paid first, debt holders get placed. All these people are placed in a higher position than the individual who owns the equity. So the person that put up the $500 in equity, they were really on the line. They were completely trusting in the business plan that I put together. They were counting on me to deliver on that business plan and to increase shareholder value. But the debt holder was expecting me to perform, of course, but the debt holder also had the benefit of security of any assets that the corporation owned. As an investor, we want to be thinking about that. Do we want to invest in debt, or do we want to invest in equity? Or do we want to invest in assets that are going to be secured by debt? All of these are the types of questions that we as investors need to be asking. Debt is far safer than equity, but it doesn't provide as much of a return. So it's really important to always be thinking about risk and return. And there are many different types of debt we can invest in. The safest debt that we should be thinking about if we ever want to invest in a fixed income type of an instrument, debt, we may want to buy United States government bonds. That's the safest type of debt that is out there. But United States government bonds only pays a yield of 3% a year on average. That's about where we are right now. So $1,000 worth of government debt is only going to provide the investor with about $30 a year in interest. Not a lot to get excited about, but it's safe and it's predictable. If I'm going to buy debt in a small company like Michael's Hot Dog Stands, there's a lot more risk at play. And I've got to take that into consideration as well. So if I can buy debt from the US government and have it guaranteed by the strength of the entire United States government, I may only get $30 a year. But if I'm going to invest in a small business like this, I'm going to want a much higher yield on my money. I'm going to want to get paid a lot more because I'm taking on more risk. And that's why this debt holder got 10%. But regardless of what I'm going to get in interest, I'm never going to have the level of risk that I would have if I am an equity shareholder. And this concept of risk versus reward applies to both equity and debt. If it is a business that is more risky, like a startup, I have a higher level of risk that I have to consider. And so I'm going to negotiate a higher level of equity. So all of these are concepts that I would encourage you to learn about if you are going to begin pursuing your career in business as an investor, or even if you're just trying to build your own career. The more you learn about how businesses operate, the better positioned you are going to be to begin to seize opportunities and to take advantage of opportunities that can enhance your return on equity, return on investment. These are the types of concepts that I thought about when I began my venture after prison of trying to build my career. And as I said from the very beginning, I chose to begin my career as an investor in real estate because I wanted to mitigate my level of risk, and I wanted to maximize my possibility of earning more money. So in the next video, what I'd love to talk with you a little bit about is how do you exit a business? How do you eventually pull your cash back out and start living your life? And then we are going to compare and contrast that exit strategy with another type of investment, the type that made me much more successful than perhaps I have a right to be for somebody who made so many bad decisions as a kid and went to prison for 26 years. But I am absolutely convinced if I didn't understand business, I would not have been as successful as an investor. So I want to share these lessons with you, and that's what I'll share in the next video. My name is Michael Santos. I do hope that you've subscribed to the program and that you've looked at some of the courses that offer this concept of business with a lot more detail in smaller doses. So, we do have other courses where we specifically focus on financial statements, or specific courses where we focus on raising capital or corporate structure or building credit or equity versus debt. And I just wanted you to have this overview with this course on business, and that's what we're offering here. So back soon with episode, I think it's going to be episode number 7, where we'll talk about exit strategies, real estate, and the stock market.